Hi, I'm Peter Rose, founder of Longwood Currency Trading. I want to discuss trading Forex during periods of economic news release times. Not exactly trading the news release, but periods surrounding either before or after, or in the event where maybe a couple of days in a row or something one day and then you skip a day and another day. In other words, there's periods where economic news is being released. That can be things like non-farm payrolls, income, spending, unemployment, that sort of thing. Those are all high economic indicators of the health of the economy, and of course, those indicators are guideposts for the Federal Reserve or the whatever central bank you have in your country to determine their interest rate policy. I mean, the big dog in this is interest rate policy. So you have indicators that, or economic news releases that will cause the central bank to want to hold or increase the interest rate, or other indicators that tell them, well, maybe we should lower the interest rates. Now, you can get all wrapped around the axle studying these types of indicators. There's probably 40 different economic indicators, of which maybe 4 of them are key, like non-farm payrolls or the PPI or the CPI or something like that. Do you need to study all that stuff? You don't need to study it, but you do need to know when you're going into periods where you're going to have either that sort of economic release activity or some sort of major other vehicle news type events going on. Price of oil, maybe there's a political event or economic event in the world where you're going to radically affect the price of oil, or maybe you have political elections in a country that are going on, or something like that, that's ultimately going to work its way down into the economy to affect the employment and all the other stuff that will ultimately affect the interest rate policy. You have to bear in mind in the currency market that just because a minor economic release comes out, they're not going to have the immediacy of effect. Well, I mean, they will if you have a big change in them. But generally speaking, they're not going to have the immediacy of effect against enough of an economic policy such that the value of the currency is going to change that radically. You may get retail traders taking bets on either side of that, and 50% of them are going to be wrong, and so you're going to have these pin bars or doji type price actions during that price release. The only things that may happen, you'll get a major economic release like a non-farm payroll, and if that's way out of whack, you'll get a spike that will be really continuing in that direction. Maybe that's a result of the past 2 releases that have been slowly, maybe let's say increasing. Then you get a big jump when everybody was suspecting a small jump or a decrease. Then not only are you going to get a big spike in the price, but that price action, after you get a normal retracement from that price action will continue in that direction, because the policy, the necessary policy that's going to control client order flow in the Forex market is going to change and take on this new environment. That's a lot of economic theory, but it all plays out in the chart. The only thing you have to be aware of is, when do these releases, this information come out? Pick the economic news releases that are key. The non-farm payroll, like I said, the consumer price index is another good one. Unemployment numbers are another good one. So just maybe 2 or 3. When are they going to come out? Don't concern yourself so much with keeping track of them. You've got enough work to do to keep track of your currency price that you're actually dealing with, let alone taking on what different economic indicators are doing. You just have to know when the news is going to come out, because some of the people are going to be wrong, and they're going to be reacting to the people who got it right, and they're going to be continuing to add on to their positions, which puts a lot of stress on the guys that are on the opposite side of that, and they're going to be getting out. So when everybody is satisfied with getting into the position, the other people are still scrambling to get out, and that doesn't sometimes happen until that accelerating price begins to slow, and they go, oh, well, that's as high as it's going to go. It's not going to come down. It's not going to go up any further. I'm just going to take my loss and get out, right? And so they'll start bailing out, and that will cause the price to retract a certain degree. If you don't get a 50% retracement, it means that not all the people were wrong, that everybody's pretty happy with where the direction has gone. So you have to look at that price action and make a judgment call on your part as to whether you think price is going to continue in that direction, or that's simply an anomaly created by the retail market, and half of those guys are going to be wrong, and price is going to come back down to where it was and continue on in the direction that it was going in. Those are experience-driven decisions. What if you don't have that experience? And most of the folks that watch my channel, for the most part, are trading very small accounts, and they don't have that experience they're trying to learn. And my advice has always been, don't worry about trading fundamentals, don't worry about trading technical analysis. Trade the price action, because that's simple. There's simple rules that you can develop. Will those rules give you the right answer every time? No, absolutely not. That's where your win-to-loss ratio comes in. Well, if you're learning what to do and you don't have my guidance in order to understand the importance of that win-to-loss ratio, you don't know what that is, what do? You have to adopt a position of going all in and coming all out. I've got 3 mini lot capability or 3 full lot capability. I go in at my take point. If I get stopped, I go all out. If it goes to my profit target, I come all off. Or if I make the decision to get out early or after, they all come off. You don't ever stage out of a position, because that reduces that increases the amount of risk that you took, and it decreases the dollar value of what you're going to gain when that moves. In any event, there's a lot of advice out there that says don't trade when you get these volatile periods based on these economic news releases. Well, if you go to a site that will publish and give you a month's worth of these releases, these major releases that the different countries have, you're going to see that almost every day there's some news release that's coming out. And if it isn't every day, it's 3 times a week anyway, that your country is going to be on there with some kind of news release. So you do have to know what the major indicators, economic news indicator releases, what those major ones are. And I've already said that non-farm payrolls is a good one, consumer price index is another one, and employment is another good one. They're all related, and they all have to do with the health of the economy, which again is going to manage the interest rates. So if you want to know anything, you want to study something, study interest rate theory. What happens to your country's currency price on increasing interest rates? What happens when interest rates are decreasing? If you get a grip on why that interest rate affects your price, then you'll begin to understand why the different component pieces affect the interest rate to go up and why other ones affect it to go down. And then it all makes sense to you. But if you just pick up a book, like a lot of the information that you have out there, and you go, oh, it's non-farm payroll, and I can't trade there because nobody trades during non-farm payroll. Why not? If you get it right, you can make 2, 3, 4% on your money. If you get it wrong, which is highly likely because usually it goes in the opposite direction that you would expect, because the guys that are, let's say the guys that are long, that are betting long on an NFP, and NFP goes in the opposite direction, and they're going to sell out of their positions right away because they know they're wrong. And so you're going to see that price go down, for example, and then it'll recover immediately, and then you get the spike up because you flushed out all the weak people, and now everybody's bailing in to take advantage of it. So if you're on the right side of it, then you're golden. If you're on the wrong side of it, you can't sit there with an open set of orders. You have to have a stop behind it, and you have to understand that stop's going to get hit a larger number of times than your win-to-loss ratio, because that's just the reaction that you're going to have depending on the intensity of that particular economic release. And that's why they say, well, if you're going to have an on-farm payroll or a CPI release, just stay on the sidelines and wait until the dust settles. And that's fair. If you get a little bit more experienced and you're good at setting your stop, wait until the news comes out, see which direction the price goes in, and I'm telling you, and a non-farm payroll or a CPI release, price will go in 1 minute, could go 40 or 50 pips. So you have to have your finger on the trigger. You can't do limit orders in this stuff. You have to have your finger on the trigger so that you go, okay, this is a sustained move in this direction. I'm going to go boom, 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 boom. Uh-oh, it's going in the wrong direction. Close all. And when you do that, and you've staged in, maybe you staged in 4 or 5 times, your last 3 are going to be negative. So are you going to make any money? If it goes way in the favor and then it comes back against you, see, that's where the difficulty comes in. And if you're a beginner learner, you shouldn't be doing staging anyway, because you don't have the skill to judge what the distance between the stages should be, the number of lots that you're going to trade at each stage in point, any of that stuff. So best that rule sit on the sidelines, that you can trade during an economic release time, which means you got to have the economic calendar up 9 o'clock. I'm going to get this release. I'm going to have a cup of coffee at 9, and then at 9:15 all the shit will settle, and then I can go back in and I can trade that. Why not? Because how long do you think it's going to take for people to figure out that they're wrong when that thing goes 30 pips and then it doesn't come right back 30 pips? That's going to tell you something. Again, if you learn how to trade, then you'll know how to do all this stuff. You don't have to learn about non-farm payroll events and interest rate theory and all that other stuff. You just look at what price is doing. If it starts really ripping on you and you're wrong, get out right away. You base it on the ATR. If you're trading down on a 5-minute chart, you get a 5-period ATR, and all of a sudden you see that the candle sizes are going to 8 and 10, 12 pips. Just don't trade. Get out. Take whatever profit you've got and then cut it, because that thing could slam back against you so fast. Just don't take the chance because you don't have the experience to trade that event. Once that price starts to spike, just ride it with your single position and go down on the 5-second chart, and as soon as that thing starts to chatter a little bit, just cut it. Take your 3 or 4 or 8 pip gain, and so what if it goes on another 40 pips? You don't have the skill to determine how long you should hang on, and you don't have the bank behind you to take a release. I've seen those things go up 40 pips and then drop down 80 pips in 20 seconds. You don't have. You're going to get frozen. You're going to get hung up in that. So if you know that there's an economic event coming, don't trade 5-8 minutes before, because people start taking their positions and you're going to go, oh, this is what's going to happen. That's not what's going to happen. Those are people placing their bets, and you don't want to be in that, even 10 minutes before. And then 15 minutes after it's over, and after the bodies are all on the ground and you see where the tide of battle is gone, then if you want to place some trades, then go ahead. But have your finger on that closeout button right away. Because you're going to see so many of these events on a weekly basis, you really have to know those major events. Usually the minor ones, you'll get a maybe a 2 ATR jump on the next candle, and then it'll settle back and everything is okay. Because most of this lower economic activity is already baked into the current price, because there are people who are aware of this stuff that are placing their bets according to what they foresee the economic conditions are going to be. They're either going to, current economic conditions are going to be supported by, from a probabilistic standpoint, these minor news releases. And so people place their bets assuming that things are going to continue on. They've got the experience to do that. But they're positioning themselves perhaps a little bit heavier 10 minutes before that opening, because there's more information as to what the thought factor is around what that news release number is going to be. You don't have that ability, but you can see the jockeying for position. It's a lot of fun to watch. You don't want to be in it, though, because your balls are going to shrink up. And uncertainty as to, should I be long, should I be short, it's going long, it's in my favor, should I add, should I get out, should I run it, uh-oh, here comes a retracement, it went up 20 pips and now it came back 30 and I'm 10 underwater, and by the time you say that, it goes another 40 pips and you're underwater, and you want to take a 40 pip hit on a mini count, or even on a single full lot position. That's $400. You want to take that chance. There's always going to be economic news release periods going on. My advice: study interest rates. What happens if the news is going to impact the interest rate? Will the news be significant enough, even though it doesn't impact the interest rate right now, which it won't? It'll impact it the next time the Fed comes out to make a decision. But if you see that economic news is going to affect that interest rate in a certain way, then bet in that direction, not in the direction perhaps that price is currently going in, because it could in the future cause that return. And when that news comes out, again, half of the people are going to be wrong, and you could get a radical pullback, and then see 15 minutes after the release, where do things stand 15 minutes after the thing comes out. You're looking at those shorter term charts because you're making short term decisions. If you want to sit there trading on a daily chart and put your stop, where are you going to put your stop? You're sitting at a 80 pip ATR daily candle, and you got an NFP coming out. What are you going to do? You're going to set your stop 2 ATR, 160 pips below that. I've seen price go 160 pips in 30 minutes, 15 minutes. Are you going to sit there with you and take that when you could be on a 1 minute chart and see these big hyper extended ATR candles? You get a quarter of a pip on a 5 second chart, or maybe a 1 pip, 1 1/4 pip on a 1 minute bar, and all of a sudden that bar is 8 pips. You're not going to see that on the daily chart. So if you're going to be looking for that information on the shorter time frames, why aren't you trading on the lower time frames? If you don't want to trade on the lower time frames and you want to trade on the upper time frames, then you better not be in there during any of these major economic releases, because you don't know and you can't see it and you're not participating in that. And if you're trading on a daily chart and somebody tells you to drop down in your time frame so you can see what's going on, then you have to ask yourself, why in the hell are you trading on a longer time frame? Why are you trading on a daily time frame? You shouldn't be. I don't think there's safety in the daily time frame. I think there's more safety trading on a 1 minute time frame and a 5 minute time frame than there ever would be on trading up on the daily. Now, You can debate that all you want, and there's certainly people that are comfortable trading on the dailies. The problem is that when you get this retracement, has that gone far enough on that daily basis not to take you out such that you get 20 pips? Do I get 20 pips trading down on a 5-minute chart in a day and get out and be flat at the end of the day and not have to worry about it? Don't complicate your life trading on the higher time frames, particularly around all of these major economic news event releases, when you could be much safer simply not trading that day and not trading on the higher time frames so that you're in the position during one of those news releases. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.